David, I'll just start with you. I mean, the fact that we're 5% off the highs on the Nasdaq tells you what exactly?
So I think it's really interesting because if you had gone to sleep a year ago and woken up today, I think you wouldn't necessarily have any idea of the volatility that we've all been through. But I think that what we're seeing here in terms of tech and the outperformance of the big growers is really twofold. The first thing is that they do have a bit of a tailwind given everything that's going on. You know, more people working from home, more people doing things remotely in general. That is very supportive for the tech sector and the big growers broadly. But I think that the more important point, and we get asked this question by clients quite often, is think about the world that we're going to go back into when all of this is over. We're going to be right back in a world of 2% growth, structurally low inflation, very low interest rates. And that's the environment that got tech to where it is today over the past 10 years. And so I think what you're seeing is that there's both a short-term case and a long-term case that can be made for the continued outperformance of the big growers. And I think that's why you see the Nasdaq so close to its peak earlier this year.
You know, it's an interesting point, Julia, and it makes me wonder about two of those preconditions, low inflation and low rates. I mean, again, yesterday we had some of the Fed futures going negative. Where are you on the prospect, possibility, desirability of negative rates?
So the negative rate debate is not an active one at the Fed. They've been very clear about that they see this as a weak tool with a lot of logistical complications given the structure of our financial system. So when you're looking to stimulate the economy, you want to use the most powerful tools on your tool shelf. That continues to be, in their mind, bond purchases, mortgage and treasuries, as well as the credit programs that they're focused on ramping up. And as you said, they've got a lot of work to get those fully functional and pumping credit into the real economy. So that is definitely their area of focus. Negative rates is a theoretical debate at this point and not the best tool for the U.S. economy.
What do you make of the market signals then? Should we read these as merely technical? Should we read it as there's so much demand for treasuries, for instance, that it's possible the market could push those rates negative regardless of what the Fed does with the benchmark?
I mean, that is possible. And we do know that the Fed is going to be aggressive in its purchases of treasuries. So, I mean, I think we know in terms of the low inflation, low rates, I definitely think that is the right characterization of the environment we're going to be in. And then there is the theoretical debate. It is a debate that, you know, legitimate economists are having. It's a policy that's been put in practice elsewhere in the world. So it's not unreasonable. It's just not front of mind for the Federal Reserve. So I think if we're going to go down that road, it would be at the earliest a couple of years from now. So I think really the bigger hurdles for the Fed right now are these credit facilities. And as your last segment discussed, actually getting money into the hands of businesses and consumers that need that bridge financing to get to the other end of this. This ramping up, I mean, I think what Powell's been very clear about is that this ramping up process is going to take quarters, years, it's not going to be an overnight a V-shaped recovery by any stretch. And I think we're seeing that. They're hearing that from their business contacts. And I think that's where his focus lies.
Yeah, and I honestly wonder, David, if the Fed really wants to lend at all. I mean, that's the vibe I can't help but get by some of the conditions and terms and things and overly cautious way in which they're rolling this out, which I guess takes us back for just a final comment, if you would, on the different sectors. I mean, again, this program is potentially could help some publicly traded companies, is neither meant to nor meant to avoid them altogether. But you said you like technology for all of the reasons that everybody else and you well mentioned. What about healthcare, which in some ways has been hurt as much as helped by coronavirus? You know, what about energy? What about the banks? You know, what would your thoughts be on some of those other parts?
Yeah, absolutely. You know, I think when I look at the more cyclical value sectors, so some of those you mentioned, things like energy, things like financials, I mean, those sectors tend to outperform when economic activity is accelerating and interest rates are rising. So there will come a time to position with more of a cyclical tilt. I'm not sure that it's necessarily upon us right now. I share some of Chairman Powell's concern about starting the economy back up and some of the challenges that we're going to face here over the next couple of months. But, you know, in the interim, we're really showing a preference for quality. We do like tech, as I mentioned earlier. We like healthcare as well, but, you know, we are trying to differentiate within the healthcare universe, not only between large cap relative to small cap, and we would have a preference for large cap, but also focusing more on the pharmaceutical names and less on the medical device providers, as they've obviously been hit here as hospitals have been forced to basically only deal with COVID-related issues. And so we're really trying to balance quality and cyclicality so that we can ride through what we think will be a volatile next couple of months, but then simultaneously be in a position to ride that big market move higher as the economy comes back online and as those cyclical sectors outperform the way that they have historically during big stock rebounds.
No, it's quite a feat to pull off. It's a very complicated environment. David Lebovitz, Julia Coronado, thank you both today.